Hey guys, welcome to Real Job Optional Freedom. Real estate can be complicated. Let an investor guide you. We are here to demystify the complex nature of real estate by getting you answers from professionals who are in the trenches so you can be the hero of your real freedom story. Welcome to Real Money, a weekly segment of the Real Freedom Podcast. We are where we ask the most pressing real estate questions. That's always a tongue tire. I'm here with my co-host Kevin Gilbert, and I'm Chris Bell. Today, we are going to talk about the recent Fed hike of federal funds rate of half a point, and we're going to get into what we think that's going to do to the real estate market going forward, and just have interesting conversations around that and where we think real estate is heading over the short run and long term here. Kevin, what do you think after you saw Jerome Powell increase the federal fund rate half a point?
Yeah, if you're a regular homeowner getting a regular old mortgage, it's anywhere from 5 to 6% now. So that changes things. Where a year ago you're looking between 3 and 4, and for a long time we're even under 3, somewhere in the twos. That's a big deal. We were talking earlier about like the numbers of your buying potential at those rates. If you're looking at your paycheck and X dollars can go towards housing, it changes the math a lot. It changes your the neighborhoods you can look at, what it changes the math across the board, right? So we've had this demand, just like a bidding war across the table for an extended period of time now. When people are looking for houses, they're making 20, 30 offers and getting rejected every time. I think that's all about to stop. I think they're raising these rates to fight inflation, and I think the inflation's coming. And what does that mean? That usually means that rent is not going down; it's going to go up. So we're going to see less buyers. We're going to see, what those buyers their purchasing power decrease. We're going to see the pool of renters go up. So for investors, that means that there's a shortage of housing across the board because of the pandemic and availability of rentals and houses to buy. But I think for landlords, this is going to be a good thing. You're going to have a lot of renters looking, a lot of demand. Rent is going to go up, both as a combination of inflation and demand for those properties. And well, what does that mean for us as investors? With rental properties, I think it's a fantastic thing. Real estate is a hedge against inflation. When you're buying a non-dollar asset that is a house, somebody's lending you money against it, whether it's at 3% or 6% or even higher percentages, right? 7 or 8%, the math still works, provided you get all your numbers in line and the rents are going up. So what I think, and I hate making predictions because I was wrong in 2006, 2007 when the market fell apart, but I think change is coming, and I think the rent's not going down. I think it's going up. But that's what I'm seeing.
Yeah, no, it's pretty interesting. You look at this and you see, I think the stated inflation CPI is 8.5%. We all know that that's drastically understated.
Yeah, they don't include in the important things anymore. I think they took fuel out now. And it's like,
yeah, so they basically messed with how they measure that 2 times over the last, I think, 30 or 40 years. They've changed how they've calculated the math on CPI. If you were to look at it, I think there's a site that tracks this stuff. I think it's Shadow Investing. And, they're saying, our inflation, if it was measured the way that they used to measure it long ago, it would be somewhere in the, 16 to 17%, where I can tell you right now, if people saw that number in the economy, if that was the number that was showing, it would almost create panic in the streets, So the other thing that's really interesting is our Federal Reserve they were buying these mortgage-backed securities like over the last several years. I mean, they were buying, uh,
Trillions.
yeah, like, and it was hundreds of billions every month. So basically, the banks had this opportunity to go out, lend at these ridiculously low rates because they were getting low money too, and then they were able to sell it basically to the Federal Reserve. And
I think they were buying about 20% of the market, right? And if you suddenly stop buying and 20% of your pool of of people to sell to disappears, that makes a big change to your market overnight, right?
Yeah, absolutely. So the banks are like, whoa, wait a minute. We've got to hold the paper now. We can't sell the paper, to the government. So that really has a big impact. And the other thing I think, if you look at this just at a bigger macro level, right? Interest rates were historically low in the twos, low threes, and um, a big part of the housing market in the United States either refied or purchased homes with these low interest rates. So the likelihood of like the mortgage industries doing really well over the next probably 10 to 15 plus years, that industry is going to be hit pretty hard. So that's also on the banking
We're
sector.
Yeah, we're already seeing estimates of refinances are going to drop 65%, mortgages across the board at least a third.
Yeah, there's no reason for people to refinance because they've got these low interest rates. The other thing that's going to do, Kevin, is if you've got a 3% interest rate on your mortgage and you can make that payment, there is no reason for you to sell your property. So guess what? There's going to be a lot fewer homes on the market, and the homes that do come on the market are probably going to be newer construction. They're probably going to be people that, were forced to sell, had to sell, that type of scenario. Because as you get into the market again, you're looking at these higher interest rates and you're going, well, wait a minute. Like, even if I get a bunch of cash from selling my house, and I put that down on the next house, um, I'm going to be paying a much higher interest rate, and potentially my payment is going to be higher. So these low interest rates they are going to have lasting impacts on the housing market um, that a lot of people just aren't really, paying attention to. You're
One of the
probably,
things I used to watch is Home Depot numbers, right? And I bet you this is going to affect that. Like, do I move and pay 6, 8, 9, 10% interest, or do I stay, get a second mortgage for 30 grand or whatever, and redo the kitchen or add a bedroom or fill in the blank? I bet you you're right. I bet you it's going to have lasting consequences for quite a while. You add to the family 3 to 5 years from now. Do you move and get a bigger house, or do you say, we're going to get a second mortgage for 30, 40, $50,000 and stay here? I think you're right. I think that's going to have a bigger impact than anybody's prepared to account for.
yeah, it could definitely open up also the home equity line of credit market, right? Because people have got more equity in their homes than they ever have in history. So it could open up that area of the banking sector. And again, exactly what you said, people taking out, basically second mortgages, home equity lines, what have you, and doing the renovations at their property. And the other thing, Kevin, you hit on this, but it was, basically people buy houses on the payments, not on the price. And we ran the numbers here recently just to look at, what has happened in just a very short time frame. We're talking, basically in 3 months, interest rates have gone from, 3.5% or lower on a 30-year fixed mortgage up to, basically the low side right now is basically 5.5% interest on a 30-year fixed mortgage. And if you were in the market 3 months ago for a $350,000 home, that equated to about just principal and interest payment of $1,571. So let's just call it, we'll call it 1,600 just to round up, right? So you were in the market for a $1,600 a month principal and interest payment. Now with the interest rates going up to that 5.5% range, and this is if you've got stellar credit, we're talking almost 800 credit scores here. In order to get that payment around that $1,600 number, the purchase price of the house is not $350 anymore, it's $280,000. So
That's
talking
78,000. No, that's more than 20%.
It's right at a
huge
20%
difference.
drop. So we've got looking at basically a 20% drop there in order to buy on that same payment schedule. And I could hear people right now, they go, well, housing is all based on jobs and wages and what people can afford. But I can assure you that wages have not gone up that much over the same time period, over this 3-month period. Like you
Especially
haven't
if you're
had
looking at
wages go
those,
up like that.
especially if you're looking at those real inflation numbers you're talking about, where 18%. No, we know government employees, the families are still getting the 3% adjustment for living expenses. You're like, well, that's that's a joke in this day and age, right? So, yeah.
Yeah, so it's really interesting when you start looking at that, and and then you factor into it that there's this massive housing shortage, and I've heard other talking heads online basically say, hey, there wouldn't be a housing shortage if we had foreclosed on all these people during the pandemic that didn't pay, or we had evicted all of these people that we couldn't evict because of the foreclosure and the eviction moratoriums and that sort of thing. But I think that maybe they really didn't take into account that these things take time. Like it's whether you're building new houses and bringing them onto the market, like you don't just all of a sudden bring 4 million houses onto the market. It's it's staggered. It's every month there's maybe 100,000, the next month another 100,000, like, and it staggers up. And the same thing with the evictions and the foreclosures. Like it's taken 2 full years basically of not foreclosing on folks, at the same levels that they were, and not evicting people at the same levels that they were, to kind of get to this point. So like you miss that time component of it all. So you still have the shortage of housing. It's just now it's going to take that much longer to basically build back up.
I think there's another piece there. That's that's one side of it. There's a supply issue there, but I think these interest rates are also going to change the demand. You're going to see less people just interested in or able to buy these houses at these prices. I think an extreme example is if somebody can't afford housing, they move in with a relative, right? So there's 10,000 ways to reduce the demand out there, but people still need a place to live. And I think you're right. I think that supply might slowly ease up, but when do you approach what we're used to as normalcy? When does that happen? Is that 2 years out? I don't know.
Yeah, I think the other thing too, right, is you look at this stuff, right, and you just like, so what's interesting about housing, if you look back at the '08 crash, right, like it started coming down in '08, right? People were panicking, but it didn't hit bottom, like the absolute bottom just nationally, until around 2012. And some markets were sooner, some markets were a little bit later. But generally speaking, 2012 is when it hit bottom and started coming back. So it took 4 years for this thing to go down, and it's because it ratchets down. It's basically you've got the neighbor who basically is getting foreclosed on in the bank. Now they can't sell it at 300, so now they're trying to sell it at 280, and maybe it sells at 280, and then the next house goes into foreclosure. And you start seeing that trend line just kind of come down, come down, come down, come down. The same thing happens when these markets go up. It's the neighbor was selling for 300 and now the next door neighbor thinks that they can sell for 315, and somebody brings some cash to the table and that house sells at 315, and then the next person thinks they can sell it, 325, so it ratchets up, and it takes time for that to happen in the marketplace. So as we see these higher interest rates and it's kind of lowering that demand down, you'll start to see housing prices come down. I don't think we're going to see a drop. There's no, in my mind, I don't see a crash happening here, but I definitely see prices coming down and softening. And we'll probably start to see that over the next 3 to 6 months. So you're looking at towards the end of the summer of 2022 to the beginning of 2023, where you'll start to see some of that supply demand side come into effect with the interest rates.
That's one of the things I always liked about real estate is compared to say the stock market, the swings are nowhere near as drastic. You have actual time to react and time to think these things through. So as an investor and a person who's looking to purchase rental properties, man, the next year is pretty exciting for me. I'm looking for opportunity there, right? And I think, those buying rentals, I think you're going to see astronomical returns. I think there's a lot of opportunity coming, especially versus something like the stock market. Like just real estate's, even at these interest rates of 6, 7, 8%, whatever we end up on, I think there's a lot of opportunity coming just because of the inflation and where the market's going as far as supply, demand, and the inflation as a factor.
Yeah, absolutely. And I think, when you look at it, we've talked about this. Investors don't buy houses, just speculating on, hey, I think the thing's going to go up in value. Like, investors are looking at the numbers and they're basically saying, hey, if I buy this, regardless of what the interest rate is, even if the interest rate was 18%,
I'll buy at 18.
Is the math going to work out where it's going to be cash flow positive? So if you're buying for cash flow, it really doesn't matter what the interest rate is. It can be double-digit interest rates as long as you can buy the property at a lower enough dollar figure to get your payment in line, and then maybe rents have gone up. And so now you're renting and you're getting more in rent than what your payment, your taxes, insurance, all your costs are. It's really going to be a great time to be an investor and pick up some prime properties in good locations.
And I think that's one of the things I love about real estate is, yeah, I'll buy at 18%, but that means the property's dirt cheap, right? It's all a math equation. So if the payment's here, but the interest rate's up here, that means the total value of my purchase price is going to be way lower than we're seeing today, right? So all these numbers adjust. But the interesting thing about 18% interest is last time that happened, it didn't stick around forever, right? So, you keep your rental property, but you refinance, and some of your numbers that were survivable and okay, and you were getting a return become astronomical. So, and the banks love it because so maybe you've had this house 6, 7 years from now, and the banks are ecstatic because now there's equity there. So I don't know. Anytime I look at the possibilities of what's coming, I see it's good for people looking to get into or acquire more real estate. So I think it's really strong, and I'm excited about what's coming. The time frame is a question mark, and how extreme, right? You're talking about not seeing a crash. I don't know that I see a crash either, but even a 15, 20% change, even just the market cooling down is going to create a lot of opportunity.
Yeah, absolutely. And I think, there's going to be creative ways to basically buy real estate, both now and in the future. The market basically makes some of the creative ways of buying and exiting from real estate viable. So if you look, and you probably remember, like way back in the day, you had assumable mortgages where people could assume your mortgage. Like if you wanted to sell, they could just come in, assume your mortgage and pay the difference. And there's similar strategies with, buying properties subject to a loan, that type of thing. And I think you'll probably see more of that type of thing as we go into, maybe the next 5-year span of investing. You'll see a lot more of that type.
All right, that's a lot of industry lingo there, Chris. To translate, he means I will buy your house and take over payments. Not replace the mortgage, no new financing. You just walk away, and the investor is now making the payments on your mortgage. That's as removing the lingo as I can get with that one. But but I do think you're right. I do think that's coming, where investors are going to be like that 2 or 3% loan has value, even if the principal might be higher than I'd normally be willing to pay in the new market. If you're looking at a 10, 20-year time frame and you see a cash flow value there, it's going to create a lot of math. The calculator is going to show you some astronomical numbers in the next year or two, I think, and I'm excited to see what's coming.
Yep. Absolutely. So guys, if you like this episode, make sure to hit the like button, subscribe, click the bell so you know when we've got new content coming out. We appreciate you guys being with us. And if you've got any questions for Kevin or myself, please put them down in the comments, and we'd love to answer any questions you guys may have about real estate or certain markets that we're in. So take care, guys.